So today we are going to be dissecting portfolio theory, and I will take my time to explain the concepts, and at the same time, once we are done with the explanation, then we begin to solve illustrations. For today, we are going to discuss, you learn about the introduction to portfolio theory, what is portfolio management. You will also learn about modern portfolio theory, okay? We are going to discuss risk-return trade-off. Then we move to discussing portfolio risk, all right? Portfolio diversification, and any other things that we may need to touch as far as portfolio theory is concerned. All right. So let's start uh, from introduction. What do you understand by portfolio theory? Okay, what is portfolio theory? Before we begin to talk about that, let me give you a kind of, let's say, for example, you as an investor, you have 100 million naira. Let me say 1 million naira for simplicity. Okay, you have 1 million naira. And this 1 million naira that you have, you want to put it into investment opportunities, but you don't know the kind of investment that you should put the money. Therefore, of course, since you cannot do this directly, you need to approach a portfolio manager that will carry out the investment on your behalf. All right. The portfolio manager has several investment opportunity that this 1 million naira can be invested on. For example, the part of the 1 million naira can be invested in stocks, which are shares. Shares and stocks are the same thing. America call it stocks, British call it shares, so they are the same. All right, so you put part of the money in stocks or shares, part of the money may be invested in bonds. Okay, you can put some in energy. All right, you can invest in real estate. You can put part of the money in commodity like gold. All right. Not only that, you can invest some part of the money in exchange traded fund, ETF, exchange traded fund. You can invest in mutual funds. All right. So all these investment opportunities are what we call portfolio. So when you talk about portfolio, portfolio represents the collection of several investment instruments, including bonds, shares, real estate, and other similar securities. This is what is known as portfolio. All right. So the collection of several investment instruments, including bonds, shares, real estate, and other similar securities. That is portfolio. There is difference between portfolio and portfolio management. Okay. There is difference between portfolio and portfolio management. Portfolio management is the art of building and managing different investments that is consistent with the long-term goals and long-term financial goals and risk tolerance of an investor. I will repeat. Let me even put it down because I'm not sure it's in this material. Now, I said portfolio management. Portfolio management represents the art of building and managing several investments that is consistent with a long term financial goal and risk tolerance. Long-term financial goal and risk tolerance of investor. Okay, so that is portfolio management. For example, this portfolio I mentioned the other time, like I said to you, it is your portfolio manager that will do the investment, that will carry out the investment on your behalf. So the way that the portfolio manager will construct your portfolio in such a way that will be consistent with your financial goals and risk tolerance is what we call portfolio management, because it is the portfolio manager that will assess the objective, your financial objective, that what do you want to achieve, because the financial goal of every individual investor differ. All right, type I don't write on my screen. So the financial goal of every investor differ. All right. For example, the financial goal of a working class is different from the financial goal of a retiree. All right, because as a retiree, your financial goal may be to have a stream source of income that will take care of your retirement. All right, because at that moment in time, once you retire, you don't have opportunity, no strength again to continue to work. Right, so you want to input your financial resources in an investment that will be able to take care of your retirement. All right. So your retirement, your financial goal, you as a retiree, your financial goal may be that you want to ensure that maybe you want to construct owner occupier building. You want to build a house, all right? So so that when you retire, you have somewhere to rest your head and to put in to accommodate your family, all right? Your goal as a retiree may also be that, okay, anytime you need money to spend on family, you have money available to do that. So you want to have stream source of income, all right? So your financial goal as a retiree may be that you want to go on vacation every year so that you have money for you to be able to enjoy life, all right? So this may be your financial goals, which may be different from a working class person. For example, as an employee, your financial goal may be that you want to buy a car, right? You want to buy a car. So because you don't have the full amount to purchase the car, the little that you have, you want to put it into an investment so that in the next in the specified in the next future, let's say for example in the next 5 years or thereabout, you'll be able to have a complete money to purchase your car. All right. So you as an employee, your financial goal may be that you also want to build a house, right? You want to build a house when you retire. So you started saving money. The money you save, okay, let me put it into investment, all right? So that by the time I'll be retiring, let's say for example in the next 10 years. So how much will it take me? How much do I need to invest now so that in the next 10 years I'll be able to have sufficient amount of money for me to be able to build my own owner occupier building? So all of these things are what we are discussing, because like I said, the financial goal of every investor will differ. Not only financial goals, because as you are talking about the goals that you want to achieve, every investment has its own peculiar risk. All right, there are risks associated with every investment. Therefore, the risk appetite, the risk tolerance of every individual differ. For example, the kind of risk that an individual, let's say for example, in one of your promise, for example, can say, okay, if you ask promise, if you can jump on top of a building, I'm going to give you 10 million naira. Of course, promise we need to assess the return that is coming to him versus the risk from jumping from the on top of a building. If I jump from top of a building, what's the worst case that could happen to me? All right. So possibly maybe there will be a kind of a fracture, or can that result to fatality? So all of these things, as you are talking about the return that is coming to you, then you also need to compare that with your risk appetite. You can ask another person that if you can jump from a fence to the ground, I'm going to give you 2 million naira. So the individual will also need to assess the risk versus return that is coming from that particular undertaking. If I jump from a fence, what's the worst thing that could happen to me? The worst thing that could happen is the risk. The money that the individual will receive is the return, all right, from taking that risk. So all of these things are what we are going to be discussing. So purely, this is the introduction to portfolio theory, and I can bet you portfolio theory is a very interesting area of financial management. It's a very interesting area. In fact, in practice, for some of you that are working in asset management company, you will understand better. You will appreciate better what portfolio theory or management is all about, because you're already working there. You can relate with what I'm saying. Okay, then let's talk about modern portfolio theory. Okay, modern portfolio theory. The modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. I repeat, modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. Okay, that is modern portfolio theory. The theory stipulates that the theory stipulates that a risk-averse investor or a rational investor should not only focus on the securities in the portfolio, all right, but should also consider how the securities in the portfolio relate to one another. I repeat, modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. It is a theory that the theory stipulates that a rational investor should not only hold portfolio, but should also consider how the securities in the portfolio relate to one another. All right. Now, let me explain that. You see, it is not just about putting your investment, putting your money, or committing your limited scarce financial resources into investments. If you are going to, for example, all this portfolio, all these investments you have in this basket, this is portfolio of investment or basket of investment. So all this investment, you want to know, it is not sufficient for you to commit to have portfolio, all right? To have portfolio of investment. You must consider how they are related to one another. That is what we call correlation coefficients, all right? So you want to know what's the relationship between shares and bonds. How does bond relate to energy? How does energy relate to ETF, real estate, commodity, and all of that? Are they positively related or negatively related, or no relationship at all? All of this is also important as a rational investor. You must consider how they are related in the portfolio, so that the essence of doing that is to minimize your portfolio risk. You don't want to ensure that these securities are not related. Because if they are related, if anything happened to that industry, all your investment will be gone. So, but if they are negatively related, if they're in opposite direction, then of course, no issue. If one of the investment is not doing well, then the other part, since they are not related, your money will still continue, so that you won't be able to lose the entire investment. So this is what modern portfolio theory is talking about. So the investor should not only focus on the portfolio, but should also consider how the securities in the portfolio relate to one another. The modern portfolio theory, the modern portfolio theory uh, states that a risk-averse investor uh, do not like risk. That is, a rational investor is an assumption. The portfolio, the modern portfolio theory is based on the assumption that rational investor do not like risk. Okay, nobody likes risk. As a rational investor is an individual that have the understanding of the market. So in relation to the expected return and then the risk associated with the investment. So that is a rational investor. Now, this rational investor, when you talk about modern portfolio theory, we said it is a theory. I mean, the rational investor do not like risk. That is, given an investor a high level of risk, he or she will expect the same level of return. But where two or more securities have the same level of return, the investor will select the security with a lower risk. Let me take this one so that we can express it in a table, in a graph rather. Let me see. Okay, let me switch to, okay, let me continue first before I switch to my working notes. Now, what we are saying is that for when you talk about modern portfolio theory, I said the theory is based on the assumption that a rational investor do not like risk. Rational investors do not like risk. That is, given an investor a high level of risk, he or she will expect the same level of return. And where two or more securities have the same level of return, the investor will select the security with a lower risk. This information I just provided can be demonstrated in the efficient frontier graph as shown below. Now, what do I mean by efficient frontier graph? We said that a rational investor do not like risk. And therefore, because they don't like risk, and they also want to maximize their return, which is not possible, then because your return must be consistent with the level of risk that is available in the market. Therefore, so as a rational investor, since you do not like risk, and then where two or more securities have the same level of return, then of course the rational investor will select the one with a lower risk. And I said this can be demonstrated using efficient frontier graph. Examiner can ask you to explain modern portfolio theory. And when you do all of these are the things you are going to be talking about. And you also need to, if possible, when you are doing your explanation, you have to talk about efficient frontier. So using efficient frontier graph, okay, starting from 0, the horizontal axis of this graph is represented with return. This is return represented on the horizontal axis. Let's say this is return level 1, R1, then return level 2, R2. Let me remove this. R2. So this is return. Then the risk is represented vertically. Here is risk as measured by standard deviation. So this could be risk level 1, then risk level 2. Okay? Now, you have to plot the risk against return. Okay? So, Then you join this. This can also go up like this. Now, you then need to find the point of intersection between risk and return. You will notice that risk and return intercepted at this point. Let me change the color. Risk and return intercepted at this point. They intercepted at this point and also at this point. All right. So let's say, for example, this is security A. This is security B. And this is security C. So you need to join efficient frontier will start from the origin and pass through the middle of the graph. So this will be the efficient frontier. Let me use another color. Okay. All right. So the line that passed through the middle, that passed through the origin through the middle of the graph is what is known as efficient frontier. This is efficient frontier. All right. Therefore, after drawing your diagram, after drawing your graph like this, you must explain what do you mean by the diagram? Because this is what we call modern portfolio theory. So you have to explain your diagram. Now, to explain this, let me look for, I may need to switch to the working notes. Because this, I don't have sufficient space here. In any case, let me just talk through it. Now, when you look at this diagram, you will notice that security A and B, I will manage it. Okay. Let me see. Let me use my working notes so that I can fully express myself. I don't want to be switching from one page to another. Let me stop sharing this. So like the way that I've drawn before, let me just redraw it here. So so starting from origin. All right. So we have this. We also have this. So you then find the point of intersection between risk and return. This is point A. This is point B. And here is point C. So like I said, you are starting from the origin. This is return on the horizontal axis. Risk is on the vertical axis, denoted as standard deviation. So we have return level 1, and then return level 2. We have risk level 1, and then risk level 2. So we are starting from origin, which is 0. Okay. And I said that the efficient frontier is a line that passes through the origin, that passes from origin through the middle of the graph. So that is the efficient frontier. Now, after you have drawn the graph, you need to explain the graph. Therefore, to do the explanation, okay? Now, when you look at the graph, you will notice that at R1, at return level 1, security A and B have the same level of return. Let me just, because of time. From the graph above, number 1, securities A and B have the same level of return. R1, but different level of risk, D1 and D2. Remember what I said, risk is measured by standard deviation. So when you look at our graph, you will see that in this line, this is return level 1. Security A and B, they have the same level of return. But when you look at the vertical axis, you will notice that security A has risk level D1. Security B has risk level D2. So they have the same level of return, but different level of risk. Therefore, which of the two securities will you prefer between security A and B? Of course, because the two of them have the same level of return, but security A has a lower risk. Therefore, security A will be selected, will be preferred over security B. So you can then come here. The second explanation, security A with a lower level of risk relative to security B is preferred because, like I mentioned to you, where two or more securities have the same level of return, investor will select the security with a lower risk. All right. So then number 3, we have explained the relationship between security A and B. Let's explain relationship between security B and C. Now, from the graph above, you will notice that security B have the return level R1. Okay? Security B, and C have the same level of risk, D2, but different level of return, R1 and R2. Okay? Between security B and C, which one will you prefer? They have the same level of risk, D2, but the return of security C is higher than that of security B. Therefore, security C, it will be preferred. Security C with a higher return as compared to security B is preferred. Okay? So that's the explanation of the relationship between security A and B, and then B and C. All right. Then number 5, from the graph, securities A and C. Securities A and C are preferred. Security A and C are preferred over security B and dominates. Let me put it this way. Security A and B and C lie on the efficient frontier. On the efficient frontier line and dominates. Security B. Number 6, each number is a point where a security is preferred and dominates another security. The preferred security is said to possess a stochastic dominance. Okay? It says security is said to possess a stochastic dominance. Somebody can ask, what is stochastic dominance? A stochastic dominance investment is the one that is better and preferred by investor. So any securities that is an investor preferred over another, that is a stochastic. That means that security possesses a stochastic dominance. Everybody wants to invest in that particular security in any condition. They will always choose. They will always select. They will always choose that particular security. So any security that is chosen over the another is said to possess a stochastic dominance. All right. Point number 7. Okay. The choice is between securities A and C. The choice between security A and C. So let me reframe it. The choice between securities A and C will depend on the characteristics, on the nature, characteristics, and risk tolerance, or risk appetite of the individual investor. Okay, of the individual investor. This one is not in your notes. That's why I'm taking my time to write it down. All right. So the chart, when you look at, like I've explained in this diagram, our selection is for security. Security A and C lies on the efficient frontier, and they are preferred over security B. So our choice now, because as a risk averse investor, or as a rational investor, you can either invest on security A or C. Both of them are preferred, right? But the choice between A and C will then depend on the nature, characteristics, and then the risk tolerance of the individual investor. So a risk, for example, number 8, a risk averse. A risk averse, when you say risk averse is an investor that do not like risk, all right? So because you don't like risk, then that means you have a lower appetite for risk. If you have a lower appetite for risk, then you must be able to undertake or to earn a lower return. All right. So a risk averse, let me write this. A risk averse investor will select or will choose security A. Security A with a lower risk and return. Whereas whereas a risk aggressive investor will select security C with a higher risk and return. So like I said, both security A and C are fantastically okay. All right, both security A and C are good, but the choice between the two of them will depend on uh, the risk appetite or risk tolerance of the individual investor. So this is the explanation of the graph. So by the time after today, of course, you are going to have access to this working notes, so you'll be able to learn more about this. So this diagram on its own is the explanation of modern portfolio theory. Is the explanation of modern portfolio theory. Like I said, modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. The theory stipulates that investors should not only focus on the securities in the portfolio, but they should also consider how the security in the portfolio relate to one another. The theory is based on the assumption that investors do not like risk. That is, given an investor a high level of risk, he or she will expect the same level of return. And where two or more securities have the same level of return, the investor will select the security with a lower risk. And I said this can be demonstrated in an efficient frontier graph as shown below. And that's why I draw this diagram for you. All right. You are not going to draw the diagram alone. You also need to explain. All right. You need to explain the diagram. So to explain the diagram, I've given you about 8 items, 8 different points that you need to explain the diagram. So next thing we are going to talk about is the risk-return trade-off. Risk-return trade-off. Examiner can ask you to explain risk-return trade-off. What do you mean by risk-return trade-off? This represents the positive relationship that exists between expected return and risk. Okay, that's risk return relationship. What this is saying is that if an investor cannot expect a high return and also expect a lower risk. It is not possible. All right. So the two, both return and risk must match. Therefore, higher return is not possible. Higher return is not possible to attain in an efficient market. In an efficient market and over a long period of time and over a long period of time without accepting a higher risk. So what it simply means is that the risk return relationship must be consistent. All right. They have to align. If you want to take a higher return, you must be able to accept a higher risk. If you desire a lower return, then of course the risk must also match the return that you have taken. All right, the return that you have earned. So all of this is what we know as what is called risk return trade-off. Okay, the next point that we're going to discuss would then be, let's talk about portfolio risk. Okay, let's talk about portfolio risk. After this, we'll move to portfolio diversification. Portfolio risk. What do you mean by portfolio risk? Portfolio risk, this is a chance that the actual return may be different from the anticipated or expected return. You know, when you want to invest, you have a financial goal that you want to achieve. Your financial goal may be that you want to earn a return on investment of 20%, for example. Market condition, the prevailing market condition, the economic dictates or government policy can limit or can impair your investment or limit your ability to maximize or to earn your anticipated return. So the actual return, who is this? Noriyat, you are writing on my screen. Stop it. So if once the actual return is different from the expected return, that is your desired return, that means it's a risk, right? So portfolio risk is a chance that the actual return may be different from the anticipated return. It is also an event. It is a possibility. It is a possibility. It is a possibility that it is a possibility that, 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 parts or all of the original investments may be eroded. Investor can lose part or all of the investments. That's a risk. You can imagine what happened in 2008 when there was economic meltdown. The entire stock market crashed and investors lost huge sum of money. In fact, some investors committed suicide as a result of that incident. You can imagine investing all your life savings in buying shares and all of a sudden the market crashed. What do you think will happen? That's a risk, right? So this is what we are talking about. So portfolio risk is measured by standard deviation. Let's move on because of time. Portfolio risk is measured by standard deviation. And the higher the standard deviation, the higher the risk. And vice versa. Okay, so that is portfolio. Let me stop sharing so that this mark on my screen can disappear. That's the handiwork of my lady in Isolo. Okay, so let's move on. What are the types of portfolio risk? Types of risk. This is highly examinable at this level. Examiner can ask you. There are two types of risk. One is systematic risk. Then two, unsystematic. Let's explain each of them. What do you mean by systematic? Okay. Who is doing crew there? Taibat, mute, please. Okay. So what do you mean by systematic risk? Before I put it down, you will recall what happened in 2020 when the entire world was under lockdown. Businesses could not operate. Individuals could not relate the way they used to do before that event. You will see that during COVID-19, everybody in the entire world suffered the consequence of COVID-19, either directly or indirectly. In fact, some people even lost their lives to COVID. That's a risk. You can imagine you have an investment and because you could not operate, you could not work in your office, you could not work to continue with that investment. You have to put it on hold because the entire world was under lockdown for a period of about 4 months. Businesses could not operate, could not access their building or their offices. All right? That's a risk. Any risk that affects every individual business or companies in an economy is what is known as systematic risk. Any risk that affects everybody within a country or in an economy is what is known as systematic risk. So when you talk about systematic risk, this is also known as beta, okay, general, let me write that general. Market imposed, okay, unavoidable, all right, unavoidable, non-diversifiable. Let me shorten it. Let me stop at here. Or non-diversifiable risk. It is a kind of risk that affects all the businesses or companies in the economy. Okay, so any risk that affects every business in an economy is known as systematic risk. It is a risk that every investors would like to pay for in order to avoid, which is not possible. Let Dangote is the richest person in Africa. As rich, as wealthy as Dangote, if he has the opportunity to pay for COVID-19 during that time, he would have done it. Elon Musk is the current richest person in the world. If he has the opportunity to pay so that COVID-19 will not impact him or his business, certainly he can afford it, but it is not possible. All right? Nobody can avoid unsystematic risk. That's why it is called unavoidable. It is not avoidable. All right? It is market imposed. It is general. General means everybody will bear it. That is systematic risk. What are the causes or reasons for systematic risk? Causes or reasons for systematic risk. So like I mentioned the other time, pandemic can cause this. That is COVID-19. It's a good example. Okay? Another example or causes of systematic risk is economic meltdown. When there is economic meltdown, everybody will suffer because the economy in that particular country, once the economy in the country suffers, then everybody living in the country will also suffer it. Like I mentioned the other time, in 2008, there was market crashed. The stock market worldwide, there was a market, should I call it market disturbance or market catastrophe? Because during that particular period, in the entire world, investors in stocks market suffer huge losses. And as a result, so this is an example of systematic risk. Then number three, we can have political turmoil. All right. So when this happens, when there's political unrest in a particular country, This can also result to unsystematic risk because when there is a political unrest, there will be no peace. If there is no peace, there is no business. If there is no business, there will be no profit, no income. There is no way you'll be able to earn income. Look at what is happening in Iran. Look at what is happening in Afghanistan, Pakistan, and all of that. The current war between America, Israel versus Iran. So these are the issues, geopolitical unrest. Look at what this has within few weeks. The prices of fuel has increased. When the prices of fuel increase, everybody within the economy will suffer it because the price of goods and services will also go up. For example, if transportation cost, because fuel has direct impact on transportation cost. So because the fuel price has increased from 850 something, 860 something before to now 1,200 or some 200 and something, so over 30% increase. So when this happens, the producers that are buying it, that are using input to manufacture their goods, to manufacture their products, they also need to incorporate the burden of the increase in the transportation cost into their pricing. So once they do that, the price at which the consumers will buy things in the market will go up. So everybody will suffer it. Even if you are not buying things, maybe you are a dependent, you are not buying things, your guardian that will be paying the money will bear the brunt. If you are hitting 3 square meals in a day before, because prices of those goods have gone up, your guardian will reduce it to 2. So that means indirectly you are also suffering from that particular act. All right. So these are the things we are talking about. Then number 4, we have inflation. So like I just mentioned, now the prices of fuel has gone up, then which also translates to increase in transportation cost and then increase in the items the commodities you buy in the market. Number 5 is changes in inflation. Sorry, changes in interest rates. So if interest rates increases, investors that want to borrow loan for the purpose of producing goods or render service, when you borrow loan for the purpose of production at a higher rate, then you also need to transfer the cost, your cost of borrowing into the price of the goods or service. So this would make the prices of goods and services in the market to also go up. All right. So, and of course, this is also part of that's a risk. All right. Then every other thing that of course, war is also part of it. When in a country where there's war, there will be there will be no peace. And if there's no peace, right, there will be no business. All right. So these are some of the examples of systematic risk. Then the second one is unsystematic risk. What do you mean by unsystematic risk? This is also known as specific non-market imposed avoidable alpha or diversifiable risk. It is a type of risk. It is a type of risk that is peculiar to a particular company company in the economy, the particular company or industry in the economy. All right, that is unsystematic risk. It is avoidable. For example, some of you will recall sometime in February last month in Lagos, there was Access Lagos Marathon race. During the period, some section of Lagos Road were restricted for movement. Therefore, that means all businesses along the areas where there was restriction will not operate on that day. All right, that means there's a risk for the fact that you are unable to operate. For example, equity professional in our VI center, we could not operate on that day. We couldn't have lecture on that day because there was restriction of movement. We could not commute. Students that are coming from Aja Axis, Lekki, within VI, students that are coming from Ikoyi, CMS, they could not access the center because there was restriction of movement. Lecturers that are coming from the mainland, for example, those that are coming from Ikeja, from Solo down to VI, they could not pass through Third Mainland Bridge because there was restriction of movement. But other businesses that are operating in the areas where there was no restriction, they operated. In fact, our center in Solo, we opened on that day. All right. So you cannot see this is what this is what we call unsystematic. It is avoidable. It is not specific. Sorry, it is specific. It is non-market imposed. It is avoidable. Unsystematic risk is diversifiable. You can shift it. You can shift the risk. You can diversify it. All right. So what are the examples? What are the causes? Okay. Causes or reasons for unsystematic risk. Okay. Number one, product recall. Product recall. For example, some of you will remember some years ago, about 4 or 5 years ago, Samsung made a recall in one of the Samsung S Galaxy model because the phone was generating heat. Customers complained and the company made a recall on the product. So what I mean is that you can imagine a company that has spent money to produce that particular product. Now you are calling it back. You are withdrawing the product from the market. That would be at a loss. So what that simply means is that other companies operating in the phone industry will not be impacted like other companies like Apple, like Nokia. Those companies that are operating in phone industry will not be impacted because this particular product recall is specific to Samsung. The second one is management change. Management change. When there is management change, it will only affect a particular company, not the entire companies in the industry, because every company have a different kinds of management team and they manage the quality of the quality and experience of every individual management team differ. All right. So when there's a change in management structure, this can impact. This will affect it will affect the company itself, not the entire company in the economy. Then number three, another example is location or poor location. If a company or business is sited in a location that is not easily accessible, this can affect the ability of the company to take advantage of market condition. All right. So if a company is wrongly cited, this will impact the success of the business in the market. So because the company is poorly located or cited, then this is what is known as unsystematic, because it is peculiar to the company, not other company in the economy. All right. So there are several other examples which we can talk about, but because of time, so this is sufficient. Let's move on. Now, let's talk about portfolio diversification. Portfolio diversification. To save time, let me use the okay, let me just continue. I wanted to use the study material to explain portfolio diversification, but let's just continue. Diversification. Okay. Now, earlier today, I explained, I draw up a basket of investments in a portfolio, right? I mentioned stocks, bonds, energy, commodity, exchange traded fund, mutual funds, and the likes, all right? So all these investments, which of course you want to put your money, they are the portfolio of investments. When you talk about portfolio diversification, is a kind of strategy. Because of time, let me put it down. This is a strategy that mixes several investments, several investment opportunities, or let me call it several investment instruments that will react to market gyration differently, including investing in bonds, shares, real estate, etc. What we are saying is that portfolio diversification is a strategy that helps rational investor to avoid a disastrous financial outcome by spreading the limited scarce financial resources among several investment instruments that will react to market condition, all right, differently, that will react to market when there is gyration, it means that there's fluctuation, there's volatility, all right? So when this happens, because you have diversified your investment, instead of, for example, like I mentioned the other time, you have 1 million naira. Instead of investing the entire 1 million naira in shares to buy shares of a particular company, you spread it across. You construct your portfolio by ensuring that by putting, for example, 30% in shares, 20% in bonds, 5% in real estate, 15% in exchange traded funds. So you spread it across like that. That is diversification. Okay, because of time, let me just continue with this. Diversification, portfolio diversification helps a rational investor to avoid a catastrophic financial outcome by spreading the limited scarce financial resources in several in different in different securities such that if of the security if one of the securities is not doing well, there will be others. There will be others to fall back on. Okay, so this is portfolio diversification. All right. So like I mentioned, you have 1 million naira. Your portfolio manager will need to construct your portfolio. Out of this 1 million, 30% may be invested in shares. Another percentage, let's say 15%, in exchange traded fund. Your portfolio manager may put like 20% in real estate. All right. Another percentage, let's say 10%, may be invested in bonds till you are going to get the 100% of your your limited scarce financial resources. So this is what we call portfolio diversification. The portfolio diversification teaches irrational investors not to put all eggs in one basket. So instead of investing your 1 million naira in a particular company, for example, right now since the 2024, effective 2024 February, the Apex Bank in Nigeria roll out the recapitalization exercise for the banks. All right, that all the banks in Nigeria should recapitalize. That means they will have to introduce additional capital. Okay, so that particular any company, any bank in the industry that is not able to raise the capital, that's a risk because they won't be able to, their license will be withdrawn. That's a risk. So now those people, if the banks, they are now seeking for public funds. They want the public to come and subscribe to their shares because that means they need to raise additional shares. For the purpose of raising the shares, once they raise the additional shares, that means they are inviting the public to come and invest. So you, as a prospective investor, maybe your neighbor, your friend, or a family member has approached you that, oh, one of the banks is raising capital in the market, and I will advise you that you should subscribe to the share. You should buy the company share, right? So let's say, for example, you have a 1 million naira and you now spend the 1 million naira to buy, then your entire 1 million naira saving, you now spend it, you now invested it in the company's share. And if at the end of the day the company is unable to meet up with the with the apex bank, with the CBN requirement for recapitalization, what do you think will happen? That means the bank will go down. Is either the bank will collapse, or the bank will merge with a bigger bank in the industry. All right. So what portfolio diversification is teaching rational investor is not to put all your eggs in one. That is the simple truth of portfolio diversification. Let me put it down for you. Portfolio diversification. What's wrong with you? Portfolio diversification teaches a rational investor not to put all eggs in one basket. That is, you don't put all your money on a particular investment. When you talk about portfolio diversification, this is where you don't have experience in doing this. It is your portfolio manager that will do it on your behalf, because you need to construct the assets in such a way that will be consistent with the financial goals and the risk tolerance of the particular individual investor. All right. So if you put all eggs in one basket, if anything happens in that particular industry or happen to the company, all your investment will be gone. Look at what happened in 2002 when Enron, one of the top 5 companies in the world, collapsed. Enron collapsed in 2002. Why did the company collapse? So many factors contributed to that. Okay? But the bottom line is that when the company was doing well, between 1990 and the early 2000, between 1990 and early 2000, some retirees and employees of the company invested in the company. They invested in the companies. Part of their pension, or part of their salaries were being invested in the business. And because they believe in the performance of the company is doing well. I mean, the company was doing well, and then they believe that, okay, the company will continue to do well. So the retiree of Enron contributed in the pension account, I mean, in the pension activity of the business. All right. If for example in Nigeria, employee is supposed to contribute 8%, then your employer will contribute 10%, total 18%. But employee can also contribute additional funds into the pension. All right. So some of the retirees and employees of Enron, of the former Enron, invested in that. And when the company collapsed, that means the retirees could not have a beneficial financial outcome. They experience a catastrophic, a disastrous financial outcome, because they lost all their investment. Where are they going to start all over again? At that age, you have already retired, no strength for you to carry on again, and the company collapsed. This is what we are saying. So portfolio diversification teaches every one of us. It's not just about company, including individual, not to put all your eggs in one basket. So anytime you have money and you are thinking about investment, please seek financial advice. Meet with your financial advisor for proper guidance. These are the people, the professionals are the people that are endowed with experience with the requisite experience and exposure to guide you on your investment journey. Don't think because your colleague is, don't carry out emotional investments. There's nothing like sentiment in investment. You must be aware of the market dictates before you put in your financial resources into any investment. There are so many factors you must consider before you invest your 1 naira in a company's shares. So all these things, this is not just about theory. You are not reading this because of the exam you want to write. This is the way it is done in practice. Because of time, let's let's move on from here. All right. So this is what we call portfolio diversification. That is the simple term. The simple term of portfolio diversification is that don't put all your eggs in one basket. That's it. It's as simple as that. Okay. Now, how do you minimize portfolio risk? This is examinable. How to minimize portfolio risk. How do you minimize portfolio risk? Because let me just summarize this. To minimize portfolio risk through diversification, let me rush up so that we can complete this topic. To minimize portfolio risk through diversification, a rational investor can invest in securities that are negatively correlated or securities with no correlation. So if you want to minimize portfolio risk, you must consider the relationship between the two securities. Preferably, ensure that you put your financial resources in securities that are negatively correlated. That is, securities that are in opposite direction. You can invest in shares of a particular company, all right? Then in a particular industry. You move to another, you can also buy, you can invest in bonds of another company in different industry. So ensure that they are not in the same industry. All right. So you can invest in financial service like banks, insurance company. You can put some money in oil and gas industry. You can invest some money in education. You can invest some money in part of your investment can be put into real estate. So you diversify, ensure that they are not in the same industry. Ensure that they are not positively correlated. Because if anything happens in that particular industry, all the companies in the industry will suffer it. If you like, buy shares. You have 1 million naira. You buy 30% shares in GTB. You buy 20% shares in Zenith Bank. You buy 40% shares in Access Bank. You think you are just buying shares in the banking industry. So if anything happens in the banking industry, all your investment will disappear. You are going to lose money. So you are going to spread across your investments. You spread your investment across several industry, different companies. All right. So this is how to minimize portfolio risk. In addition, in addition, a rational investor, a rational investor should also should also consider should also consider geographical should also consider geographical or international diversification. Consider geographical or international diversification. Now, when you talk about geographical diversification, for example, in Nigeria, let's say you are a resident of Lagos, you reside in Lagos State, you put all your investments in Lagos State. If anything happens in Lagos State, the entire investment will be gone. So to minimize that risk, you are supposed to invest some money in Lagos. You can go to Southeast, for example, in Enugu or Anambra to also make investments. You can go to Port Harcourt and make investments. You can go to Kano to make investments. So you spread it across geographical locations so that if there is trouble in one particular location, you still have your other investment in other location. Like during the period of Boko Haram, when Boko Haram was really tough in 2012, particularly in Borno, right? Let's say, for example, an investor has 100% of his investment in Borno, in Maiduguri during that period. That means during the entire crisis of Boko Haram, you cannot operate. Let's even say all the bomb blast affected your company. That means the investment is gone. Look, during the period of early around 2013, 2014 or thereabout, when militancy issue was tough in the South, imagine all your investment is in the South, and there was crisis of militancy when the militants were bombing the pipeline, international oil companies' pipelines, right? So you can imagine if all your investment is there, that means you could not, there's no way you'll be able to access the feed. In fact, during that period, I could remember, was it 2017 or thereabouts? Yeah, during the crisis, then I was with one of the IOCs. I was working with one of the IOCs. For over a month, the company could not access feed operation. They could not work in the feed. So they have to rely on the reserves that they have. So the company was only operating through the head office in Lagos. So they could not go to the south, to the feed, to go and operate, to go and for exploration, production activities. So you cannot imagine if all your investment is in that place, both the head office, the operation, the lifting of everything is in the south. What could have happened? And that's why till today, the South governors they've been asking the international oil companies to come and site they should move their head office from Lagos to the South, and the oil companies refused. It would be too risky to do that. It would be too risky. So this is what we are saying. So there should be a kind of job to minimize that risk. There should be a geography. You can carry out geographical investments, geographical diversification of your investments. When you talk about international diversification, instead of putting all your investments in Nigeria, you can also invest in other international companies so that if there's issue in Nigerian economy, your money that you have invested internationally you can still fall back on that. Look at the period when when there was volatile in the exchange rates in the market. If you buy something today now, they will say, "Oh, tomorrow it has increased." Why has it increased? It's because of dollar. Dollar has increased. Everybody was lying on dollar during that period, you know. But you as a company, if your investment is denominated in foreign currency, the risk will be very minimal. All right. So this is what we are saying, and that's why you see that most of our first tier banks like GTB, like UBA, like Access Bank, like Zenith Bank, they have international operation. It's one of the way of diversifying their investments. All right. So because of time, let's stop it here. So if you have the golden book, you read more on this. Now, there are types of portfolio diversification. I'm not going to speak on this. You can just read it. It's in your notes. Types of diversification. Okay, we have horizontal, vertical, and also conglomerate diversification. I will not speak on them. So go and read it in your notes. Horizontal diversification. We have vertical diversification. Then we have conglomerate. All right, so read more from your notes. Then let's talk about, we have talked about risk return trade-off. We have talked about portfolio diversification. We talk about portfolio risk. Then how do you estimate? Let's talk about how to estimate. Estimating, we are moving to calculation now. Estimating portfolio risk, return, and correlation coefficients, or you call it relationship. Okay, how do you estimate portfolio risk? Like I mentioned earlier, portfolio risk is measured by standard deviation. Let's start with portfolio risk. I need to move faster here. So how do you estimate portfolio risk? There are two types. You can have individual risk. You can also have the portfolio risk. So for individual security in the portfolio, if you want to measure the risk of individual securities in the portfolio, how do you do this? Like I said, risk is measured by standard deviation. Therefore, standard deviation for security X, let's say for example, for two asset portfolio, okay, for a two assets portfolio, let me put it down. For a two assets portfolio, let's say we have X and Y. We have security X and Y in the portfolio. So in this case, to determine standard deviation of security X and standard deviation of security Y, so you can say standard deviation will be computed as the square root, okay, square root of variance. And variance is calculated as summation of probability of X minus X bar square. All right, so this is the formula for calculating the risk of individual security. If it is security Y, it will be Y minus Y bar. You will see it as we proceed. Then for the portfolio, that is portfolio risk. If you want to calculate portfolio risk can be calculated as square root of the proportion invested on security X, where you have two asset portfolio. Proportion invested on security X, you square it, multiply by the variance of security. Let me rewrite it to make it clearer or bigger. Proportion of the amount invested on security X, you square it, multiply by the variance of security X plus the proportion invested on security Y, put it into square, multiply by the variance of security Y plus 2 multiplied by proportion invested on security X multiplied by standard deviation of security X multiplied by proportion invested on security Y multiplied by standard deviation of security Y. All of this multiplied by the correlation coefficient between security X and Y. Okay? Of course, you have to put it into brackets, into square roots. So this is the formula for calculating portfolio risk. Okay, so this is the formula for calculating portfolio risk. I will define the variable for you shortly. There is another way you can do this. You can use tabular method to do, instead of using this formula, you can use tabular method to calculate the portfolio risk. But I will show you. I will use live question to demonstrate that. But first thing first, let's move on. Then let's talk about return. So for individual, if you want to calculate return for individual security in the portfolio, to calculate return for individual security in the portfolio, it is computed as return of security X, for example, that is, you calculate expected value, expected return, so which is computed as summation of probability of X. That is, just multiply probability with the return of security X. Multiply probability with the return of security Y. All right, so that's that. Then for the portfolio, how do you compute the return of the portfolio? The return of the portfolio, RP, is computed as the proportion invested on security X multiplied by the expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. You add the two together, that will give you the return of the portfolio. Again, you can use tabular method to achieve the same result. I will show you later on. Now, remember, we said we want to estimate the risk, return, and then correlation coefficient. The third one will then be, we have talked about the risk, how to estimate the risk of individual security and the risk of the portfolio. We've talked about the return, how to estimate the return of individual security and also the return of the portfolio. Let's talk about how to estimate correlation coefficients. So relationship between securities in the portfolio. If you want to determine how securities in the portfolio relate to one another, you calculate correlation coefficient. So correlation coefficients measures the relationship between securities in a portfolio Of course, there are different relationships. I don't want to go into details in this. Let me just mention few. There are positive, negative, and zero relationship. There are diagrams for each of them, but I don't want to go into that. Okay? To calculate correlation coefficient, calculating correlation coefficient, R. In this my formula for calculating risk of the portfolio, you can see here, you have R. That R is the correlation coefficient. So in most cases, you are the one that will determine the correlation coefficient. How to do it is what I want to show you. How do you calculate correlation coefficient? Correlation coefficient, denoted as R, is computed as covariance. Covariance between security X and Y, between security X and Y over the standard deviation of security X multiplied by standard deviation of security Y. All right, so this will give you the correlation coefficient. So covariance, let's talk about covariance. This measures, or this shows, the linear relationship between two variables, between two variables. The covariance can be calculated as follows. So how do you calculate covariance? Covariance between security X and Y will be computed as summation of probability multiplied by X minus X bar multiplied by Y minus Y bar. All right. So this is the formula for calculating correlation covariance. So let's now define the variable. These are all the relevant formulas that you need when you are calculating portfolio risk and then portfolio return. So where we started with D. D equal to standard deviation of individual security. Next one, we mention P. P equal to probability. Then we mention X, return of security X. If you use Y, that will be return of security Y. X bar, expected return of security X. Then we talked about, in our formula, we also mentioned W. Okay, W X This represents the proportion of the amount invested on security X. What else? Then I also mentioned R. All right, I mentioned R. R is correlation coefficient. Between securities. Okay. In the formula, I also mentioned what else? Yes, covariance. COV of X and Y. This is covariance between securities X and Y. I think that's it. This is okay. All right. Now, for exam purpose, note. Note number 1. The return of individual security, the return of the security, the return of the security must be given in percentage. Therefore, if it is given in absolute value, it should be converted to percentage as follows. Now, what I'm saying is that on the day of your exam, note for exam purpose, okay? So on the day of your exam, ordinarily the return given to you in the question is supposed to be in percentage. You are going to be given probability and then return of individual security, right? So the return given to you is supposed to be in percentage. So if examiner give it to you in naira or in absolute value, you need to convert it to percentage before you begin your calculation. So to do this, depending on the state of nature, that is the event in the economy. So to convert your return to percentage, you are going to pick value at the end, you less the value at the beginning. Then you divide with the value at the beginning. So you multiply everything by 100%. So this will give you the percentage of the return. All right. So that's what you need to do. The value at the end will include both your investments and also the return that you have earned. The value at the beginning is the amount you have invested in the security. All right. Then point number two that you need to consider is that when the probability when the probability of the securities are different, it means there is no relationship between the securities in the portfolio. So if in the question that is R, which is correlation coefficient, that is R will be equal to 0. So what we are saying is that if in the question, let's say for example, you are given security A and B, probability of security A is 0.5, probability of 0.5, 0.2, then 0.3, which is equal to 1. The probability of security B, for example, is 0.4, 0.25, then 0.35, which is also equal to 1. So because the two securities have different probabilities, it means that they are not related. That means the R, the correlation coefficient, is equal to 0. But once these two securities have the same probability, if the two securities have the same probability, that means there is a relationship. Then you need to go and determine your correlation coefficient using the formula I gave to you earlier on. But once they have different probabilities, it means that there is no relationship. In this case, there is no need for you to go and be calculating correlation coefficient. Simply put that your R is equal to 0. Like for example here, where you have risk of the portfolio, this place where you have the risk of the portfolio, if the two securities, this place, if the two security have a different probability, it means that the R, this R that you are seeing here, is equal to 0. Just come here and put 0. And if R is equal to 0, that means all what you have here will be equal to 0. Okay, it will be equal to 0. So you have to watch out. Watch out for that. All right, then let's move on. So these are the things you need to take into consideration when you are calculating portfolio. I think at this point, we can then have an illustration. Somebody sent me a message. Let me check. Sir, please, I think you are too fast. Okay. Sorry about that, Costello. We are trying to copy the formula. Don't worry now. It will be shared with you. The notes will be shared immediately after this class. I'm going to share the notes. Then the video will come much later. All right. So yes, let me stop sharing this, and then just Costello, just hold on. After the class, immediately you are going to have access to the notes so that you can copy it from there. All right. So at this point, let's have illustration. We have spent 2 hours for explanation. My intention before was to just spend 1 hour, but now we have done 2 hours. So at this stage, let's have a illustration. Any other thing I need to comment on or I need to mention, we're going to do it along. All right. So please go back to your material. Go back to your material. Go and read more, especially if you have the golden book. Go and read more about portfolio. Is a very interesting it's a very interesting topic in financial management. Anytime, any day is very interesting. There are more information in the golden book so that you can read about in relation to portfolio. All right. So at this stage, let's have so like I mentioned the other time, the types of security, these types of diversification. I think I mentioned vertical there. The vertical is concentric. All right. Okay. Yeah, I'll give you only three examples of unsystematic risk. So you can read more on this. You can read more. I think that's that. We have covered most of it. All right. So, like I said, if you go to the golden book, you are going to see more of this. Let's do it this way. Well, we are not going to solve more than 2 illustrations. So we have 2 hours to do that. All right. So we are going to solve questions whereby you are given absolute value. Then another question whereby you are given percentage return. Okay, so let's start with illustration number 2. Uh, Let me see. Let's start with illustration number 3 before we come back to illustration number 2. Let's start with this. All right. So I need somebody to help us read it. Who is helping us? Illustration number 3, page 94. Yes.
Anyway, sir.
Yes, go ahead. Thank you.
Johnson just won 100,000 from Able Lottery Limited and has decided for the interim to place the money on 2 securities, X and Y, for a period of 1 year. 60,000 is to be placed on security X and the balance on security Y. He has estimated returns, that is cash flow to be received at the end of the year plus project value at the time. And the probabilities of the 3 possible states are as follows. We are given a figure which we assume to be correct. Required. Calculate the expected return, variance, and standard deviation of each security. B. Calculate the covariance between the 2 securities and the correlation coefficients. C. What are the returns of his portfolio for each of the possible states, A, B, and C? Calculate the expected return, variance, and standard deviation of the portfolio from these figures. D. Using the general formula for the mean return and variance of the 2 security portfolio, recompute the mean return, variance, and standard deviation of his portfolio. E. Would your answer to D above be different if the correlation coefficient has been +1, +0.0, or 0.5, or -1? What conclusion do you draw?
Thank you, Chidera. That is the question. Let me stop sharing this and then move to the working notes. All right. So in the A part of the question, examiner is asking you to calculate expected return, variance, and standard deviation of each security. Remember what I told you, there is difference between return and then standard deviation of individual security and that of the portfolio. So let's quickly solve this because of time. Yeah. Solution. So illustration 3. I think that's page 90. That's page 93 or 94. Let me confirm. Page 95. 94 to 95. Okay. The name of the investor is Johnson. All right. So examiner is asking us to calculate the expected return, variance, and standard deviation of each security. All right. So number A, calculating expected return. Variance and standard deviation. So we start with expected return. Expected return of X and Y. So we start with security X. Remember, we said that expected return is calculated as summation of probability of X. That is, simply to calculate expected return of individual security, you multiply probability with the return of individual security. So for security X, we are going to do for security X first. Because we also want to calculate standard deviation, so it means that we are going to use only one table to achieve the two. All right? Let me do it this way. Return and variance of security X. So to calculate expected return, you are going to start with probability. Probability denoted as P, then the return denoted as, in this case, since we are doing for security X, denoted as X, then we have expected return denoted as X bar. All right, so I will then go to the question to go and identify what is the probability of security X. When you look at the question, you will see that from that table, you will see that both security X and Y have the same probability. So in that case, that means there's a relationship between X and Y. So in this case, under the probability, I will put 0.3, 0.45, and then 0.25. Please, at all time, your probability must be equal to 1. Okay? So here will be the expected return of security X. So I need to go back to the question and identify the return of security Y. When you look at the in the table, you are told that predicted return at the end of the year for security X, we have 75,000 naira, 73,200, and then 67,200, which simply means that you cannot use this under portfolio. You don't use absolute value for return. It has to be in percentage. Therefore, we need to go and calculate the return in percentage. All right. So let me, without going too far, let me use here for working for returns. Conversion of return to percentage. In the question, we are given 3 different states of nature. We are given state A, B, and C. State of nature is the event in the economy. So we said return is calculated as value at the end minus value at the beginning. over value at the beginning. All multiplied by 100%. So we are going to do for each security, starting with security X, under state A, state of nature A. You then go back to the question. Like I said, value at the end is the value you have in the table. Value at the beginning is the amount you invested in the security. So out of the 100,000 naira, Johnson invested 60,000 naira on security X. That 60,000 is the value at the beginning. That means 40,000 will be invested on security Y. At the end of year 1, the predicted return is now 75 naira under state A. So 75 naira minus 60,000. 70,000 minus 60,000 divided by 60,000 multiplied by 100%. Give it to me. What do you have here? Yeah, participate.
Sorry, so how do you get 70,000? What we have there is 75,000. Am I mistaken?
It's an error.
Okay.
That's
75 minus
25%.
25%.
Yeah.
So for state B, value at the end is what?
73,200.
Minus 60,000 over 60,000 multiplied by 100%. What do you have?
22%.
22%. For state C, value at the end is what?
67,200.
67,200 minus 60,000 over value at the beginning of 60,000 multiplied by 100%. What do you have?
12%.
12%.
12%. So that's for security X. You do for security Y. Under state A, value at the end is what for security Y?
45,600.
45,600 minus value at the beginning of 40,000 over 40,000 multiplied by 100%. What do you have?
14%, sir.
14. Under state B, what's the value at the end?
47,200.
47,200 minus value at the beginning of 40,000 over value at the beginning of 40,000 multiplied by 100%. What do we have?
18%, sir.
18%. Then for state C, what's the value at the end?
48,000.
48,000.
Minus 40,000 over 40,000 multiplied by 100 over 1.
20%.
20%. So this is how to convert. This is how to convert the absolute value of your return to percentage. I need more space. Let me copy. I've exhausted the initial 1 minute. Copy this. Should be okay. All right. Let's move on. So now that we have the return in percentage for security X and Y, we can then continue with our calculation. 25, 22, 12. 25, 22, 12. Here is 25, 22, then 12. So like I said, to get the expected value, to get the expected return, simply multiply probability with the return. Therefore, what is 0.3 of 25?
7.5.
7.5. 0.45 multiplied by 22.
9.9.
9.9. 0.25 multiplied by 12.
3.
Add everything up. What do you have?
20.4.
20.4. So the expected return of security X is 20.4. All right. So that's what the examiner wants you to calculate. Before I proceed, we also need to calculate variance. So to get the variance, standard deviation, denoted standard deviation of security X will be computed as square roots of summation of probability of X minus X bar squared. So to get the standard deviation, you need to first of all estimate variance. And to get the variance, you are going to multiply probability with X minus X bar squared. So to do this, that means I need to expand this table. To expand the table, I will then say X minus X bar. Let me put it down to follow the letters. So here will be X minus X bar. We then calculate X minus X bar squared. Then finally, we calculate probability of X minus X bar squared. So this will give us the variance of security X. So let's do it together. Now pay attention, please. Our X bar is 20.4. X at each state of nature is 25, 22, and 12. So to get X minus X bar, so that would be 25 minus 20.4. What do you have? 25 minus 20.4.
4.6.
4.6.
That's 4.6. So I would then come here 4.6. Before I move to the next one, 4.6 squared is what? That's 21.16, right?
21.16, yes.
So 21.16 multiplied by the probability of 0.3 multiplied by 0.3.
6.35.
That will give us
6.35.
Sorry, sir. Please, why are you?
That's 6.348.
Excuse me, sir.
So A will be 6.348.
Excuse me, sir. Can you hear me, sir?
I will do for the next one. 22. Pardon?
Can you hear me? Good afternoon or good morning.
Yeah, sorry, I forgot to tell you the rule of engagement. If you want to ask questions, you are supposed to raise your hand. But I know we're standing. We've already spoken. Go ahead.
Yeah, so I want to ask why you deducting 20.4 from 25 and not 7.5 for X minus X bar?
You follow the simple rule of engagement, or the simple rules. We are seeing X minus X bar. Your X bar is 20.4, not 7.5. Do you get?
I thought that was summation X bar. Is that not the sum of the X bar?
Temitope, just follow the simple instruction. Your X bar, this is your X bar here. Your X bar, what you have what you have here at 7.5, that is the expected value of state A, expected value of state B, expected value of state C. We are talking about expected value of the security, not of each state of nature. So the expected value of X is 20.4. So 25 is your X. 24 is your X bar. Therefore, 25 minus 20.4, not 25 minus 7.5. Is that clear, Temitope?
Okay.
Okay, yeah.
The second one, 22 minus 20.4, what do you have?
6. 1.6.
1.6.
1.6 square.
1.6. So 1.6 square is what?
2.56.
2.56 multiplied by a probability of 0.45.
That is 1.152.
1.152. 552.
Yeah. 22 minus 12 minus
12 minus 20.4.
minus 8.4.
Somebody.
Sorry, sir.
minus-
Is
Minus
1.15.
8.4.
Hold on. Somebody, a baby is making noise at the background. That person should mute. Don't talk. So, 12 minus 20.4 is what?
Minus 8.4.
Minus 8.4. Minus 8.4 squared is what?
70.56.
Speak up. 70.56.
56.
Multiplied by a probability of 0.25.
17.64.
17.64. Add everything together. What do you get?
25.14.
5.14.
25.14. This represents the variance of security X. Variance of security X is 25.14. So we also have to calculate standard deviation. So standard deviation of security X would then be equal to square root of probability multiplied by X minus S bar squared. So what's square root of 25.14?
5.014.
5.01. All right, so this represents the standard deviation of security X. The risk of security X is 5.01. So let's do for security Y. So before that, somebody is raising hand. Sunday, Toria, talk to me. Yes, Toria, you raise hand. What's your question? Okay. Let's move on. So for security, the same way you have calculated for security X, you also do for security Y. So here is the states.
Excuse me, sir.
We have states A, B, C. You create a column for probability. You create a column for probability. Probability is 0.3, 0.45, and then 0.25. Okay, then we are given the return of security Y. The return of security Y will be here. For the return of security Y, we calculated 14, 18, 20. 14, 18, then 20. You then calculate expected return of security Y, which is Y bar.
0.4594.
Total. So 30 multiplied by 14. 30% of 14 is what? Yes?
4.2.
4.2. 45% of 18 is what?
8.1.
I didn't get that.
8.1.
0.25 of 20.
That's 5.
Add it up.
14.3.
17.3.
6.3.
This represents the expected return of security Y. That is Y bar. So to now get the variance of security Y, this will be Y minus Y bar.
That is 14.
Then Y minus Y bar square.
3 minus 3.3.
Then probability multiplied by Y minus Y bar square. So this will give us the variance of security Y. So 14 minus 17.3 is what?
Minus 3.3.
Minus 3.3 squared is what?
10.89.
10.89 multiplied by probability of 0.3.
That's 3.267.
3.267. Then 18 minus 17.3.
0.7.
0.7 squared.
0.49.
Multiplied by 0.45.
0.2205.
2205. Next one. 20 minus 17.3.
2.7.
2.7 squared.
7.29.
7.29.
1.8225.
Multiply by 0.25.
1.8225.
8225. Add everything together. What do you have?
5.31.
5.31. So that's the variance of security X. So now get the standard deviation of security Y. It will be variance, it will be square root of variance, which is 5.31. What do you have?
1.35.
2.30.
2 point what?
2.30.
30. So that represents the standard deviation of security Y. So we have answered requirement number A. Let's move to requirement number B. Before that, Nuriyat, speak to me, talk to me.
Yeah, but why? How did we arrive at it? It's doing why?
How do we arrive at Y?
We get but why?
Y bar.
Eh,
I told you to get expected value. You multiply probability with return. Return of security Y is 14 under state A. So 30% of 14 will give you 4.2. 45% of 18 will give you 8.1. 25% of 20 will give you 5. You add everything together, it will give you expected return of security Y, which is 17.3. Is it clear?
yes, sir.
All right then. I need all of you to mute. It's like you are distracting me. Let me look for only one person to be giving me figures. Olufemi Oyebode, you are the one that will be giving me the numbers. Every other person should mute, please.
Okay, sir.
Only Femi should be on. Every other person should. Pardon?
Okay, sir.
Every other person should mute, please. I don't want the noise, the background noise. It's distracting. Then we just completed requirement number A. Let's move to B. According to the question, requirement number B is asking us to calculate covariance between the two securities and the correlation coefficient. We want to calculate covariance. I would then say calculating covariance. COV. All right, between security X and Y. Like I mentioned to you, covariance of X and Y will be calculated as summation of probability multiplied by X minus X bar multiplied by Y minus Y bar. That's the formula for calculating covariance. So we then come here, states. We have probability, we have X minus X bar, Y minus Y bar. Then probability of X minus X bar multiplied by Y minus Y bar. So we have state A, B, and then C. Probability of state A is 0.3, 0.45, then 0.25. We have calculated X minus X bar. X minus X bar is 4.6, 1.6, then minus 8.4. Here is 4.6, 1.6, minus 8.4. Y minus Y bar, that is minus 3.3, 0.7, then 2.7. Minus 3.3, 0.7, then 2.7. So, to then get the covariance, you are supposed to multiply the three of them together. So probability multiplied by 4.6. 0.3 multiplied by 4.6 multiplied by minus 3.3. What do you have?
Minus 4.554.
Minus
4.554.
4.554. Next one. 0.45 multiplied by 1.6 multiplied by 0.7.
0.504.
0.504.
504.
The last one, 0.25 multiplied by minus 8.4 multiplied by 2.7.
Minus 5.67.
Minus 5.67. Add everything together. What do you have?
Minus 9.684.
Minus 9.684. Are you sure?
Yes.
684.
Minus 9.72.
Aha, because my mind is on 9.72. 9.72. Kafayat, what's your question? Talk to me.
No, sir. Is there at any point where we can be asked to calculate just covariance for like maybe only X or only Y, or it has to be both together?
No, Nak. No. Like I mentioned, covariance measure the linear relationship between variables, between two variables. You want to know what's the linear relationship between security X and Y. So you cannot do for only one. It has to be two. All right? It has to be two, even more. It can even be three. All right. So the portfolio, the security you have in the portfolio, the security you have in the portfolio, what is the linear relationship between or among them? That's what you use covariance for. So you cannot be for only one. Is it clear, Kafayat?
Yes, sir.
Yes. Lekon, talk to me briefly.
Yes, I want to ask what if the probability for each securities X and Y are different?
I've already told you that if they are different, there's no relationship. That means your R will be equal to 0.
Okay.
No need to be doing all this calculation then. Just put your R is equal to 0. So calculating covariance. Covariance is minus 9.72. Then correlation coefficient. Calculating correlation coefficient denoted as R. And we said that correlation coefficient is computed as covariance between security X and Y divided by the standard deviation of security X multiplied by standard deviation of security Y. All right, so covariance is minus 9.72. We have calculated standard deviation of X before to be equal to
5.01.
Standard deviation of X is 5.01. Standard deviation of Y is 2.3. Therefore, divided by 5.01 multiplied by 2.30. So here will be minus 9.72 divided by
11.523.
no rounding, 11.523.
23. Okay, no rounding.
So final answer is what?
Minus 0.844.
So minus 0.84.
Okay,
So that means the interpretation of this is that the relationship between security X and Y is highly negatively correlated. So there is a negative relationship between security X and Y. That's interpretation. Correlation coefficient is between 0 and 1. All right? Correlation coefficient is between 0 and 1. So if the correlation coefficient is below 50%, is below 0.5, that means the relationship between the security is the correlation coefficient, or you can say that the relationship between security X and Y is positively lowly correlated. Or you can say if it is 50%, if it's slightly above 50%, like in this case now, it's minus 0.84. Because of time, let me just put it down. The relationship between securities X and Y is highly, anything above 50% is highly, anything below 50% is lowly. If it is 1, that means it's perfectly. So the relationship between security X and Y is highly negatively correlated. So what it simply means is that the company can go ahead and invest in the two of them because they are not in the same, they have negative relationship. All right. Then number C, part of the requirements. Examiner is asking you, What are returns of its portfolio for each of the possible states? Calculate expected return, variance, and standard deviation of the portfolio from these figures. So examiner wants you to calculate expected return of the portfolio and then the standard deviation of the portfolio. Then in number D, you also have to calculate the same thing. Examiner wants you to calculate the return of the portfolio as well as the risk of the portfolio using general formulae. So what that means is that examiner wants you to use general formulae to calculate the return of the portfolio and the standard deviation of the portfolio. That means in the C requirement, you are supposed to use formula to calculate the return of the portfolio and then the standard deviation of the portfolio. So in that C, we are using formula. In D, we are going to use tabular method. So Michael, what's your question? Quickly. Number C. What's your question, Michael?
Hello, sir. Good morning, sir. Hello, sir.
Go ahead. Go ahead. What's your question?
Hello, sir.
Go ahead with your question.
All right, sir. I want to ask. I want to ask. The question that we'll be solving, we are trying to compare two security. In a situation, maybe based on exam standard, it's only two security that, because the formula we're given, we are using two security. Is there an avenue that we could have questions like 3, 4 security during exam? The formula might definitely change. I don't know.
So if it is possible, if you have more than 2 securities in this portfolio, it's the same thing. You are going to do for each of them first. You calculate for individual security first. Then of the portfolio, if you have 3 asset portfolio, for example, 3 asset portfolio, that means when you are calculating the risk of the portfolio, you have to include the third one. All right. So you have to include the third one. So anything you want to do, as you are doing for the 2, you also do for the 3. The same is the same thing. Like in this case now, let's say you also have another security,
Okay,
which is security Z. Hope you are paying attention. Which is security Z. So in this case, you are going to introduce additional column for Z minus Z bar. For Z minus Z bar. So you then multiply the 4 of them together to get your covariance between security X, Y, and Z. I believe that's clear. Michael. Let's move on. Calculating portfolio return. So in number C parts of the requirement, examiner wants you to use the tabular method, because in the D part of the requirement, you have to use general formulae. You have to use formula for D. That means for that C, you are supposed to use the tabular method. So to calculate return of the portfolio using tabular method, let me put it this way: return and standard deviation. Okay. Now, to do this, there's a format or there's a table that you are going to use, because the examiner wants you to use tabular method. So when you are calculating the return of the portfolio, you are going to keep the return of one security constant and you vary the return of another security. But in this particular question, because we have the same probability for security X and Y, so that means you are going to have 3 possible outcomes, because you are given the same probability, which is 1 for the two security X and Y, and the probability include 0.3, 0.45, and 0.25. That will be 1 multiplied by 3. That means you are going to have 3 possible outcomes. But if you are given 2 different probabilities, Then you need to multiply the probability of the first one, the number of probability of the first one with the number of probability of the second one. That will give you the possible outcome. I will show you how to do this as we proceed for another illustration. But for this one, we only have one probability for the two securities. Therefore, you are going to create a column for probability. First thing first, we have the states. We have the states. Before that, we can say, let security X and Y equal to, you can use any letter. What we are saying is that instead of having return of security X, you also have return of security Y. You need to have a combined return. So you are going to have only one return. So to do this, you are going to say that let security X and Y equal to, you can use any letter. Let's use A equal to A. So that going forward, instead of talking about X and Y, you are going to be referencing A. So I will then call me a state. After states, you are going to have workings for returns. Then after that, you have the return. Then you are going to have probability. You are going to have expected return, which is A bar. Then you are going to have A minus A bar. Then A minus A bar squared. Then probability of A minus A bar squared. This is the format. So we have states, we have three possible outcomes. We have state A, B, and then C. So to get the workings, working for the return, you want to combine the return of security X and Y. Let me complete my table first. This is the return of the portfolio, that is A bar. This is the variance of the portfolio. All right. So I will then go back to the question. Because the two security X and Y have the same probability of 0.3. All right. So I will then go to security A. What is the return of security A? The return of security X in under state A is 25%. Return of security Y under state A is equal to 14. Therefore, I will then come here. The proportion invested on security X is 60%. That is 60,000 divided by 100,000. That will give us 60%. Multiply by 25 plus the proportion invested on security Y, which is 40%. That is 40,000 multiplied by 40,000 divided by 100,000. That's 40%. Then multiply by the return of security Y under state A, which is 14. Here is 14. Next, for state B, proportion of security Y for security X is 60%. For state B, security X, state B return is 22%. State B for Y, return is 18. Therefore, 0.6 multiplied by 22 plus 0.4 multiplied by 18. Then for state C, 0.6 multiplied by, in state C, for security X is 12%. For security Y is 20%. So 0.6 multiplied by 12 plus 0.4 multiplied by 20. So give it to me. What do you have? So this will
20.6.
20.6. So this will give us a combined return. What we are calculating, what we are using is combined return. Instead of using return of A and B. So we have combined the return now. Next one is what?
20.4.
20.4. Then next one.
15.2. 15.2.
15.2. So this is the combined return of security X and Y. So probability, because the probability is the same, therefore there's no need for you to do any combination. So I would then come here. The two security X and Y, they have the same probability of 0.3, 0.45, then 0.25. So to now get the expected return, you multiply 20.6 by 0.3. What do you have?
6.18.
6 point what?
18.
6.18. Next one.
9.18.
9.18. Next one.
3.8.
3.8. Add it up.
19.16.
19.16. So the expected return of the portfolio is 19.16. To now get the variance of the portfolio, we have extended the table. Therefore, 20.6 minus 19.16. What do you have?
1.44.
1.44. 1.44 squared is what?
2.0736.
2.0736.
736.
Multiplied by probability of 0.3.
0.62208.
0.62208. Next one, 20.4 minus 19.16.
1.24.
1.24. 1.24 square.
1.5376.
5376. Multiplied by probability of 0.45.
0.69192.
0.69192. Then the third one, 15.2 minus 19.16.
Minus 3.96.
3.96 square.
15.6816.
16. Multiplied by probability of 0.25.
3.9204.
9204. Finance, add everything together. What do you have?
5.2344.
5.2344. So that's the variance of the portfolio. To now get the risk of the portfolio, standard deviation of the portfolio would then be calculated as the variance of the portfolio, which is 5.2344. What's square root of 5.2344?
2.2879.
2.29. 2.29 is the risk of the portfolio. So using tabular method, the expected return of the portfolio, all right, the expected return of the portfolio is 19.16, while the variance, while the standard deviation is 2.29. That's it. Yes, Tosin, you raise and talk to me quickly. What's your question? You are not ready. Number D, examiner wants you to calculate the same thing. Calculating expected return and standard deviation of the portfolio using general formulae. So examiner wants us to use formula to calculate expected return and also the risk of the portfolio. So for the expected return, for the portfolio return, denoted as RP, the return of the portfolio will be calculated as the percentage invested on security X multiplied by the expected return of security X plus percentage invested on security Y multiplied by expected return of security Y. Like the person that asked me the other time, Michael, let's say, for example, this is 3 asset portfolio. You then say plus, you do for Z. Let's say, for example, the third one is security Z. It says amount invested on security Z multiplied by the expected return on security Z. This is how you are going to do for it. Just add the 3 of them together. But in this case, we have only 2. So return of the portfolio would then be equal to, we have invested 60% on security X. So 0.60 multiplied by the return of security X. What did we get when we calculated return of security X?
20.4.
We got 20.4. So 0.60 multiplied by 20.4 plus we invested 40% on security Y multiplied by what's expected return on security Y? I think 17.3. Okay, so what do we have here?
12.24.
On the left, 12.24 plus
6.92.
6.92. Add everything together.
19.16.
19.16. That's the return of the portfolio. When you compare this with the return we got, when we use the tabular method, you see that they are the same. That is what the examiner wants to achieve. When you use the table, whether you use tabular method or use general formulae, you are supposed to get the same answer. All right. Again, for the portfolio risk. Yeah, for the portfolio risk, let me use the next page. portfolio risk. That is standard deviation of the portfolio. Islamia, yes, what's your question?
Sorry, sir. Please, how do you get 0.6 and the 0.4 that you use?
Examiner says 60%, 60,000 will be out of 100,000 that Johnson won in the lottery. 60,000 of the 100,000 will be invested on security X. Therefore, 60 over 100, this will give you 0.6, that's 60%. And the balance of 40,000 naira out of the 100,000 will be invested on security Y, that's 40%. Is it clear now?
Yes, sir. Thank you, sir.
All right. So for the risk of the portfolio, using formulae, you are going to pick the proportion invested on security X, you square it, multiply by the variance of security X, plus the proportion invested on security Y squared, multiply by the variance of security Y, plus, because you have two asset portfolio, security X and Y, so this will be 2 multiplied by proportion invested on X, multiplied by standard deviation of X, multiplied by proportion invested on Y, standard deviation of Y, all multiplied by the correlation coefficient between security X and Y. So if you have 3 asset portfolio, instead of 2, you are going to put 3 there. Then you extend to the third one. Of course, you are supposed to find the square root. Okay. Islamia, you can put down your hands. Now, we have invested 40%, sorry, 60% on X. So this is 0.60 squared multiplied by standard deviation of variance of security X. I think it's 25 point some.
0.4.
20.14.
Okay. Which one?
Variance of security X.
25.14.
25.14.
Okay, 25.14, yes.
Plus proportion invested on security Y, which is 0.4. You square it, multiply by the variance of security Y.
5.31.
5.31.
5.31. Okay, then plus 2 multiplied by 60% for X, multiplied by standard deviation of X is what?
5.01.
We calculated
5.01.
for X is 5, is it 5.01? Let me see.
Of course, okay.
Yes, 5.01, then 2.3. Thank you. 5.01 multiplied by 40% multiplied by 2.30. Then multiplied by correlation coefficient, we got minus 0.84. That's it. So the risk of the portfolio will be equal to, let's start from the first bracket. What do you have? 0.6 squared multiplied by 25.14.
9.0504.
9.0504 plus the next one
0.8496.
0.8496. 8496. Okay, plus the other side. Now let's do it this way. All of these sides, they are together. All these sides, they are together. But we are going to separate it because of the fact that in the E requirements, examiner has given you correlation coefficient of 1, 0.5, and then minus 1. So what I miss is that only the correlation coefficient will be changing. But in this case, for our own calculation, what you are going to do is that you will multiply 2 multiplied by the first and the second bracket. You leave the correlation coefficient, the third part. Leave this side. So give me only for this side. What do you have?
3.006.
53104.
53.
5.53104.
5.53104. Then multiply by minus 0.84. Okay?
4.9.
No, hold on.
Okay.
So the reason why ordinarily you could have just used your calculator to get the final answer, but because of the fact that in the E requirements, you are given correlation coefficient for each condition. So what I mean is that only this last part will be changing. So that instead of you to be working it all over again, you just be changing the last part. So this should be equal to 9.054 plus 0.8496. What do you have? 9 point what?
9.9.
9.9. Then the other side, 5.53104 multiplied by minus 0.84.
Minus 4.6461.
4.6461. Like
Or
this.
6, yes, or 64607. I approximated it to be 1. That is why.
Your voice is faint.
4.64607.
Don't run 607, right?
Yes.
Oh yeah. Find the difference. What's the difference?
5.25393.
5.25393. Find the square roots. What do you have?
2.29215.
2.29. That's the final answer. When you compare this 2.29 with the result we had when we use the tabular method, you will see that they are the same. All right. So whether you use the general formulae or you use the tabular method, you are expected to get the same result, and that's that. Finally, in the E part of the question, examiner is saying that, let me go back to the question. You are told what would be your answer to D above? Oh, sorry, would your answers to D above be different if the correlation coefficient had been +1? All right. So what I'm supposed to do here is to recompute your standard deviation. Number E. When R is equal to +1.
That's why I was in Bandy. Báwo ni wọ́n ṣe fẹ́ rí? Àwọn tí wọ́n sì Bandy, báwo ni wọ́n ṣe fẹ́ rí?
Kenny, well done. You are the one distracting my class. Mute yourself. Let me even see. Somebody send message. So how do you get? Okay, I've already answered that. I've explained that. That's fine. So when R is equal to +1, so in this case, our standard deviation would then be equal to, look up and pay attention. You will see that for this part, we have gotten 9.9. So I will then come here. I will say 9.9 plus the other side. The other side in this case will be 5.53104. 5.53104. 104 multiplied by We are using correlation coefficient of +1, so multiply by 1. Find the square root. So this will be equal to square root of 9.9 plus 5.53104. So what do you have?
15.43104.
15 points square
431
root of 15.43
104.
104. What do you have there? Find the square root.
3.93.
So that's that. You then move to the next one. When R equal to the next
No,
one is
0.5.
0.5, positive
Yes.
0.5. So in this case, this will be equal to 9.9 plus 5.53 104 multiplied by 0.5. Find the square root, which should be equal to 9.9 plus what? 5.53 104 multiplied by 0.5. What do you have?
2.76552.
Yeah.
2.76552.
2.76552. Okay. So add it up.
12.66552.
Okay, add it up.
12.66552.
I didn't get that.
12.66552.
What's the square root?
3.55887 or 3.56.
3.56. Then the third one, you are given 0. Correlation coefficient is 0. When R equal to 0, this is straightforward. So there will be 9.9. You know, anything multiplied by 0 will give you 0, right?
Yes, sir.
So this will be 5.53104 multiplied by 0.
9.9.
So this will remain 9.9. So what's square root of 9.9?
3.15.
3 point what?
15.
15. And the last one, you are given negative
1.
1, negative 1. When R equal to minus 1. So when R is equal to minus 1, there will be 9.9 plus 5.53104 multiplied by minus 1. Okay? Therefore, what's wrong? Therefore, risk of the portfolio will then be equal to 9.9 minus 5.53104. Then you find the square root. What do we
4.3.
have?
4.36.
4.36896.
What's the square root?
2.09.
2.09.
2.09. So you can then see, examiner is asking you, what conclusion do you draw? What conclusion do you draw? Because of time. We started with +1. When the correlation coefficient is +1, you will see that the risk of the portfolio is higher, which is 3.93. When the correlation coefficient reduces to -1, you will see that the risk of the portfolio also reduce. This means that the higher the correlation coefficient and covariance of security, the higher the risk of the security. All right, and vice versa. As you can see, the correlation coefficient is higher when the correlation coefficient is higher at 0.1. The risk is also higher, which is 3.93. When the correlation coefficient reduces to -1, the risk also reduced to -1. So reduced to 2.09. So conclusion now. The higher the correlation coefficients and covariance between securities, the higher the risk of the portfolio, and vice versa. That's that. That's that. This is what examiner wants you to do. The question looks very small. You can see we'll be doing this over 1 hour. All right. So that's that. Let's have one more illustration before we conclude. Before that, let me give you a break of 5 minutes so that we can relax, then we continue. However, if you have any question for me, let me know. Any question? So like I mentioned, immediately after this class, I'm going to share the working notes so that you can develop your note from there as well. Okay? So let's have a break of 5 minutes. This is 11:20. By 11:25, we'll continue. So let's solve this illustration number 2. You are considering investment in one or both of two security X and Y, and you are given the following information. This table involves the two security with their return and also the probability. You are required to calculate the expected return of each security separately and of the portfolio, comprising 60% of X and 40% of Y, assuming positive correlation between the possible rates of return from the share comprising the portfolio. So in number A requirements, you will calculate the return of individual security and the return of the portfolio. In the B requirements, you are to calculate the expected risk of each security separately and of the portfolio as defined above. For this purpose, the measure of risk may be taken as the standard deviation of probable variances from the expected rate of return. So in the B requirements, you calculate the risk of individual security and the risk of the portfolio. Then number C, outline the objectives of portfolio diversification and explain in general terms why the risk of individual securities may differ from that of the portfolio as a whole. So I will stop sharing this and then move to the working notes. We want to calculate the return of individual security and the return of the portfolio. Okay. Let me see the pages I have left where I need to copy. Okay. Let's manage this one first. Solution. This is solution. So illustration 2. Last page 94, I think. Let me confirm. That should be page 94. Yes, page 94. So we want to calculate the risk of individual security. We are not given the name of the investor or the company, so we ignore. All right. So we have security X and Y, and we are given three different states of nature. State of nature is the event in the economy. So, requirement number A, calculating expected return. Calculating expected return. So, we are to do for individual security and also for the portfolio. So, for security X, so we are starting from, let's start for individual security. Under the individual security, first of all, start with security X. To calculate for this, we are going to create column for probability, which is P, then the return of security X, then expected return for security, that's X bar. Then you calculate X minus X bar, X minus X bar squared. Then you calculate the variance. Okay, so we have three states of nature. When you look at the question, this particular question, you will see that the probability of security X is different from probability of security Y, which means that there's no relationship between security X and Y. So, give me the probability of security X. Let me look for somebody. Let me look for a partner among you. Who will help me? Yes, Femi, go ahead.
Probability
Give
for
me the
security, yes. We have 30%, 25 and 20.
25, 20.
Yes.
Uh-huh.
For Y.
No. I'm talking
Okay,
about X
sorry,
first.
0.3. Sorry, 0.3, 0.4, 0.3.
0.3, 0.4,
0.4 and 0.3, yes.
0.3. So like I said, at all time, your probability must be equal to 1. So here is 1. We have to be faster so that we can complete the question in record time. So return of security X. Give me the return of security X.
30, 25, 20.
30, 25, 30.
20. 20,
20.
20. Yes.
Okay. So to now get the expected return of security X, 30% of 30 will give us 9, right?
Yes.
So 40% of 25.
10.
So when you add it up, that's 25. So expected
5.
return of security X is 25. So to now get the variance, you need to extend the table. All right, you extend the table to get the variance of security X. So to do this, 30 minus 25 will give us 5.
5. Yes.
5 squared will be 25.
5.
25 multiplied by 0.3, what do you have?
7.5.
7.5. Here is 7.5. 25 minus 25 is 0. 0, 0. 20 minus 25 minus 5. Minus 5 squared is 25. 25 multiplied by 0.3 will give us 7.5. When you add it up, that is 15. Therefore, the variance of security X is 15. What then is the risk of security X? Standard deviation of security X will then be equal to the square root of summation of probability of X minus X bar squared, which is square root of 15. What do you have?
Hold on.
3.872. 873.
3.87. So the risk of security X is 3.87. Now, if I then want to calculate, we also do for security Y before we don't do for the portfolio as a whole. Let's calculate for Y. We assume all of these are working first. So for security Y, the same thing you have done for X, you do for Y. So probability, then return. This is P, this is Y, then expected return, which is Y bar, then Y minus Y bar, Y minus Y bar squared, probability multiplied by Y minus Y bar squared. So give me the,
0.2
let me push this one down. Hold on, Y minus Y bar. P Y minus Y bar square. Let me remove all of this. Okay, so give me the probability.
0.2,
0.2,
0.6, 0.6, 0.2,
then 0.2. Give me the return of Y.
50, 30,
And then
and 10.
10. Okay, thank you.
The first one is 50, not 50.
50. The first one.
The first one.
50.
Yeah, 5 and 0.
Okay. Let me complete my table. So let's multiply. 0.2 multiplied by 50 will
10,
give us 10.
10,
60% of 30, 18.
2.
Then 2. When you
That's
add it
30.
up, so
Yeah,
expected
30.
return. Expected return
Yeah.
is 30.
20.
So 50 minus 30, 20. 20 square,
400,
400. Multiply by 20%, probability, 80.
80.
Then 30 minus 30, 0.
0.
10 minus
20.
30, minus 20 square.
480.
Multiply by, that's 80.
That's 160.
160. So to now get the risk of security Y, the risk of security Y will be equal to square root of the variance. Variance is 160. So what's square root of 160?
12.6.
12.6. All right. So that's that. Now we have calculated the return of individual security and the risk of individual security. Let's calculate the return of the portfolio and the risk of the portfolio. Let me change my heading. Expected return and risk of X and Y of security X and Y. So like I said, this is more like a working. It's coming back to the main requirement later on. Yes, Ijoma, what's your question? Calculating.
Power 2 is minus 400.
Pardon?
Minus 20 raised power 2 is minus 400.
Minus 20 raised to minus 20 squared is minus 400. No, that's not possible now. Minus times minus will turn to positive. Okay? Use your calculator, you see it's positive. Minus 20 raised to power minus 20. Minus 20 squared, that will give you 400.
Minus 400.
Yeah. So calculating return and risk of the portfolio. Okay? So the return, expected return of the portfolio. What I will do is that I will demonstrate the two for you, but because of time, I will use the formula for you. Then I will show you how you are going to calculate if you want to use the tabular method for the same thing. So expected return of the portfolio. So how do you calculate expected return of this portfolio? We said that the return of the portfolio is computed as the proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. So return of the portfolio will then be equal to, we're investing 60% on security X multiplied by expected return of X is 25.
25.
Plus 20 multiplied by 25 plus we're investing 40% on X, and then expected return on security X is 30. Give it to me from the left. What do you have?
15
plus
12. That's 27.
27. So the return of the portfolio is 27. So to now get the risk of the portfolio risk, using the formula. What we are using here is the formula, not the table. Like I said, I will show you how to use the table later on because I'm cautious of the time. Therefore, using the formula, this will be calculated as proportion invested on security X, you square it, multiplied by the variance of security X, plus proportion invested on Y, square it, multiplied by the variance of security Y, plus, because we have two asset portfolio, security X and Y, so this will be 2 multiplied by proportion of X, standard deviation of X, multiplied by proportion of Y, standard deviation of Y, all multiplied by correlation coefficient between X and Y. Of course, find the square roots. By the time you take your time to review the notes, you see that it's not difficult. It's not difficult. Just have understanding of master the formula, and then you begin to solve. It's not difficult. Okay, so the return of the portfolio now, we are investing 60% on X. So this here will be 0.6 squared multiplied by, what's the variance of security X?
15.
Variance of security X is 15. So multiply by 15 for one side, plus we're investing 40% on security Y. You square it, multiply by variance of security Y, which is 160,
160.
plus 2 multiply by proportion of X, 0.6, multiply by standard deviation of X.
3.87.
We got 3.87. Here is 3.87. Multiplied by proportion of Y, which is 40%. Multiplied by risk of Y, 12.6. Is it 12.6, or let's make it 2 decimal points?
12.65.
12.65.
Yes.
That's the square root of 160, right?
160, yes.
Okay. So here will be 12.65 multiplied by the correlation coefficient of X and Y. When you look at the question, pay attention, please. When you look at the question given to us, the probability of security X and Y is different. So different probabilities are given. So if you are given different probability, it means that there is no relationship between X and Y, which means that your correlation coefficient is equal to 0. All right, so square root risk will then be equal, what's 0.6 multiplied by 0.6 squared multiplied by 15? What do you have?
5.4.
No rounding.
Yeah, 5.4 direct.
5.4 plus the next one.
95.6.
25.6. Now, plus the other side, when you look at this, the other parts, by the time you multiply everything, 2 multiplied by 0.6 multiplied by 3.87 multiplied by 0.4 multiplied by 12.6, then multiplied by 0. Everything you have on this side will be equal to 0, isn't it?
Yeah.
So let's add up everything.
31.
31. So what's square root of 31?
5.57.
I didn't get that. 5 point what?
5.57.
50.
5.77.
57. Okay. So that means the risk of the portfolio is 5.57. All right. So when you look at the return, for example, we calculated the return of security X to be 25. The risk of security X is 3.87. When you look at security Y, return is 30. The risk is also 12.65, which is consistent with the notion that the higher the risk, the higher the return, and the vice versa. So the choice between security X and Y will depend on the nature, characteristics, and then the risk appetite of the individual investor. Because when you look at security X has a lower return with a lower risk, whereas security Y has a higher return with a higher risk. Okay, but that's not what the examiner is asking you for now. So we have answered requirements A and B. So let me just put it in perspective. Let me see. Still have one more page. So let me put it in perspective. So in the A requirements of the question, you have to calculate the return, expected return for security, let me put it this way. If you like, you can put it in table. Security, then return. For security X, and then security Y. This here is 25, here is 30. So that means all what we have been doing since are just workings. Then the second part, portfolio return. Portfolio return, denoted as RP, we calculated 27. Okay, then number A2, number B Roman figure 1, we have to calculate the risk of individual security in the portfolio. So security, then risk, as measured by standard deviation. So for security X, then Y. For security X, I think we got 3.87, then 12.65. All right. Then of the portfolio, high, portfolio risk. For the portfolio risk, we calculated 5.57. That's it. So let me use golden book. Now, you know, I told you that you can either use general formulae or you use the tabular method. Whichever one you use, you are going to get the same answer. Because we don't have enough sufficient time again, so I cannot demonstrate for you how to use the tabular method. But let me use the golden book just to explain this. I will stop sharing and then share the golden book with you. Let me open it. Somebody sent in a message. Sir, square is 25 using calculator, same apply to. I don't understand what you mean by that. Taibats. I don't understand what you are trying to communicate. Can you repeat that again? Can you speak up? Let me hear
What
what
I'm
you are
trying
trying
to
to.
say is -5 squared, use the calculator, is -25. Same also applies to -20. Are we to ignore the minus sign?
Take it again, please.
I said -5, so when we are calculating the expected return,
-5.
getting to the variance, the 5 squared, also in the y section, security y, the -20 is also -400. Are we to ignore the
It's not
minus sign?
minus. There is no minus there. Once you see, when you say -5 square, -5 square will give you positive answer, which is 25. -20 square will give you 400 positive. Minus times minus is positive, isn't it, Taiba? Use your
Yes, sir, but
calculator,
use
you
the
see.
calculator. The minus sign is still bringing the calculator is bringing back the minus sign.
You are the one that made mistake, not the calculator. It's what you put the calculator that gave to you. It can't be negative, it's positive.
Hey, Lord.
Do it again.
Okay.
-5 raised to power, or just a -5 square. You will see that it will be positive. All right. So let me quickly demonstrate for you how to use the tabular method. to calculate return of the portfolio and also the risk of the portfolio, whereby you are given different probability. Because like in this case, we have probability of security X is 3. Probability of security Y is also 3. That means you are going to have 9 possible outcomes. That is 3 multiplied by 3. 3 multiplied by 3 will give you 9 possible outcomes. Therefore, you are going to keep the security of one security, you are going to keep the probability of one security, the return of one security constant, then you also vary the return of the other security. When you are done with that option, you then pick the second option, which is to keep the return of one security constant and then vary the return of the other security. That's how you are going to calculate it. So let me just let me show you. That reminds me, please, you are going to form a note. Examiner can ask you, pay attention to this, is very important. Examiner can ask you to explain in difference curve, security market line, capital allocation line, or capital market line. All of this, you have to ensure you form a note on that. Ensure you form a note on that. So look for, in your own notes, form a note on indifference curve, right? Security market line, capital market line, or capital allocation line. All those 4 items that I mentioned, ensure you form a note on them, all right? They are very simple and straightforward and also very interesting, okay? So that's that. Indifference curve. I want to show you the, what's it called? The tabular method of calculating return of the portfolio and then the risk of the portfolio. Let me see, which question is that? That should be same question number 2. Let me see. This is the question. I just want to show you. We've not answered the number C part of the question. This is the number C. Oh, my pen has stopped. Okay, let me just use my. So this is the number C requirement of the question. Please 1 minute. So to answer the C part of the question, in the C part of the question, examiner is asking you, what is the objective of portfolio diversification and why is the risk of individual security different from the risk of the portfolio? So to answer the question, the objective of portfolio diversification is to minimize portfolio risk. That's why you are diversifying. You want to reduce the risk of the portfolio in order to avoid a disastrous or catastrophic financial outcome by investing in securities that are negatively correlated or securities with no correlation. This is what I explained to you earlier today when I was talking about how to minimize portfolio risk. The main objective of portfolio diversification is to minimize portfolio risk. This is highly examinable. Examiner can ask you to explain how to minimize the portfolio risk through diversification. So to do this, the main objective of portfolio diversification is to minimize portfolio risk in order to avoid a disastrous financial outcome by investing in securities that are negatively correlated or securities with no correlation. Now, the risk of individual securities may differ. This is the second part of the requirement C, because examiner is asking you, why is the risk of individual security different from the risk of the portfolio? All right. The risk of individual security may differ from that of the portfolio because the risk of individual security is specific. It is specific. It is avoidable. All right. It is diversifiable. Whereas the portfolio risk account for total risk as far as the portfolio is concerned, you must consider both the risk of the individual and the risk of the portfolio, which is the total risk, that is systematic and the unsystematic risk. Okay. Modern portfolio theory is premised on the assumption that a rational investor do not like risk. That is, giving an investor a high level of risk, he or she will expect the same level of return. As shown in the calculation above, I've explained this one before. As shown in the calculation above, security X has a lower risk of 3.87 relative to, and then and return has a lower risk and return. The risk of security X is 3.87. The return of security X is 25 relative to security Y with a higher risk and return. The risk of security Y is 12.65, then the return on security Y is 30. All right. So the risk associated with security Y is much higher than the security X, that is over 300%, because 3.87 relative to 12.65, that's over 300% higher. However, the benefit of diversification has reduced the risk of the portfolio as a whole to 5.57 relative to the weighted average risk of security X and Y. That is, by the time you add up the risk of X and the risk of Y, you divide it by 2, it will give you the average of 8.27. So because of the benefits associated with diversification, the risk of the portfolio has reduced to 5.57 compared to the average risk of 8.27. So this is what exactly I want you to comment on. This is not what I want to, this is not the reason why I share this material. So I want to show you. So this is the answer. This is the answer to the C requirement of the question. Now, to answer the requirements, number A and B, sorry, number B, for example, number B, to answer requirement number B, using the tabular method, then, like I said, the first thing you are going to do, you go to the question, what is the probability of, we are given security X, you also have security Y. Probability of security X is 0.3, is it 0.3? 0.6, right? I don't know. Let me check. Probability of security. Yes, 0.3, 0.4. 0.3, 0.4, then 0.3, which is 1. Probability of X is 0.2, sorry, of Y is 0.2, 0.6, then 0.2. This is also 1. Now, if you are using the tabular method to calculate the risk of the portfolio and the return of the portfolio, if you want to use the tabular method, you are going to look at the number of probability given to you for each security. When you look at this, the two securities has 3 probability. This guy here is 3. That is 0.3, 0.4, 0.3. That's what gave us the 1. So we have 3 different probability. Then for security Y, it's also the same thing as 3. So 3 multiplied by 3 is 9. That means you are going to have 9 possible outcomes. Let's say, for example, we are given security X and Y. Probability of X is 0.5. Here is also 0.5, which is 1. Probability of Y is 0.4, 0.4, then 0.2. By the time you add it up, that's 1. That means this is 2 multiplied by 3. In this case, you are going to have 6 possible outcomes. So if you are given, what I'm trying to explain in essence is that when you are using the tabular method, the number of possible outcomes will depend on the probability given to you for the 2 securities. All right. So like in our own case now, for X and Y, because we have 3 different probability for each of them, so you multiply by 3. That means we are going to have 9 possible outcomes. That's why you are seeing this one is up to 9. So what that means is that now, let me just use this example just to explain this so that quickly within the next 2 minutes, I will just for your understanding, for explanation purpose. So in case examiner is asking you to use the tabular method, so using the tabular method, so you need to represent each security with a letter. We have security X and Y. You can say let security X and Y equal to A. You can say let security X and Y equal to B. You can say let security X and Y equal to M. You can represent them with any letter, because instead of using one individual different security, different letters, so you need to use only one letter. All right. So then the second step that you need to carry out is to identify how many possible outcomes that can be generated. That's what I just explained to you. Then step 3, making the return of one security constant and vary the return of other security. So in this case now, based on the combination, you are going to multiply the expected return, the proportion of individual security. In this case, 60% is invested on security X. So you are going to multiply that with the return 30. You know, we started in the question, the return of X for the first probability, the return of X is 30. The return of the second one, 25, 20. The return of this one is 25. The return of this one is 20. What's wrong with you? You don't vex. Let me clean now. Instead of cleaning, you are writing. Be careful. Don't mind I'm speaking with my pen. So the return of X for Y, for example, is 50, 30, then 10. So what we are saying is that you are going to keep the return of one security constant, then you vary the return of other security. Okay? So in this case now, if I'm starting with 30, in the first line is 30 for X. Okay, so I'm going to keep that 30 constant. Then I will vary the return of Y, which is 50. And that's why you are seeing that for the first three, when you look at the first 3 here, this first 3, you will see that the return of security X is 30, 30, and then 30. But the return of security Y is changing, 50, 30, 10. That's what you are going to do. Once you are done with that combination, you move to the next 3. The second return for X is 25. So this 25 will remain constant. Then you vary the return of Y in that order before you now pick the last one. The last return, in this case, is 20, 20, 20 for X. Then Y will be changing, 50, 30, 10. So you then multiply 0.6 multiplied by 30 plus 0.4 multiplied by 50. This will give you 38. That's the combined return of X and Y. Because I've combined return for the first one to arrive at 38, what is the probability of this 30 for X? What is the probability of this 50 for Y? You then go to your question. Probability of X, the first one is 30. Probability of Y for this 50 is 20. Therefore, 0.2 multiplied by 0.3 multiplied by 0.2. That's what gives this 0.06. You move to the next one. 0.6 multiplied by 30 plus 0.4 multiplied by 30. That will give us 30. Again, the probability of this 30 for X is still remain 0.3. Probability of 30 for Y is 0.6. Therefore, 0.3 multiplied by 0.6, that will give us 18%. That's how you arrive at this 18%. So that's how you are going to do for all of them. At the end of the day, you are going to get your probability return multiplied by probability will give you expected return for each possible outcome. So you do for all of them. Then you now sum everything together, you arrive at 27. When you look at this 27, it's the same thing as 27 we got if you use the formula. So to now get the return of to get the risk of the portfolio, you need to extend the table by calculating variance. All right. Therefore, the combined return for the first one is 38. 38 minus 27 will give us positive 11. 11 squared will give us 121. 121 multiplied by combined probability of 0.06. That's what gave us the 7.26. Do the same thing for the next one. Combined return of 30 minus 27 will give us 3. 3 squared will give us 9. 9 multiplied by combined probability of 0.18, you are going to have 1.62. That's how you are going to do for all of them. By the time you total everything, you are going to have the variance of the portfolio, which is 31. 31 squared will give you 5.57. So 5.57 is the risk of the portfolio, which is consistent with what we got when we use the formula. Yes, Lamia, what's your question?
Sorry, sir, please, how do you get the 50, 30, and 10?
Is there the question? Is the return of the portfolio? Is the return given to you for each security?
Okay, thank you, sir.
You're welcome. Costello, what's your question?
Yes, sir. I'm just looking at the combined probability. I'm trying to get the second one for 0.18. You said 0.3, which is the probability for X, right? Multiplied by what? 0.6?
Probability of Y. See, your combined probability, this guy here, this is your combined probability. Your combined probability will depend on your combined return. Okay, will depend on your combined return. Like you are asking, how do we arrive at this 1.8, 0.18? To do this, you have combined the return of X, which is 30, with the return of Y, which is also 30. So from the question given to you, what is the probability of return of X of this 30, which is 0.3 in this case? This is 0.3 here. Then what is the return? What is the probability of this return 30 for Y? The return of 30 for Y is, this is 30 here for Y. The probability there is 6.6. Therefore, 0.3 multiplied by 0.6 will give you 1.8, 0.18. Do you get? That's how we arrive at this.
Yes, sir.
Again, for the third possible outcome, the probability of this 30 is still remain as 0.3. Then multiply by the probability of this 10 for Y. Probability of 10 for Y is 0.2. So here will be multiplied by 0.20. By the time you multiply the two together, that will give you 0.06. That is how we got this 0.06. So that's how you are going to do for all of them. So your combined probability will depend on the return that you have combined together for the two securities. Is it clear, Costello?
Yes, sir. Thank you, sir.
All right, then. You are welcome. So that is end of the question. That's end of the question. Let me know if you have any question for me so that we can end the class. Let me know if you have any question for me. So please try as much as possible to go through your. Immediately after this class, I will share the video. I will share the class, the working note. Then I will speak with the responsible person to ensure that the video recording is available as soon as possible. If not today, first thing tomorrow. All right. All right then. So, yes, somebody is sending message. Let me check. Good afternoon. Yeah, I'm just joining the class. Please, which question is this? We are done already. So by the time I share the working note, you will see all the thing, all the thing we have discussed and the question we have solved. You see it there. All right. And when you watch the video, you'll be able to get along. Okay, Moses. All right. So this will be the end of portfolio theory. For those of you in Isolo, I've already started risk and uncertainty with you. And so bear in mind, when next we are meeting by the grace of God on Sunday, I'm going to combine you, the financial management student, with the PM student, because risk and uncertainty is the same under the two subjects. So I forgot to do that last week, and it was a slip on my side. But in any case, I will communicate to you. And for those of you that are online and the VI students, so we are going to combine the PM and then the FM students when we are having the risk and uncertainty, because it's the same thing. Only about there is additional scope for risk and uncertainty under performance management. But when we get there, but for the beginning, we are going to combine the classes together. Okay. So again, like I said, let me know if you have any question. Send me the WhatsApp chats. How can you get the printout pack? I don't know. Just send me the WhatsApp chats. Let's discuss that. I don't know what you are trying to communicate. So send me the WhatsApp chat on 0 for the learning material or the golden book. Send me the WhatsApp chat on 07064972788. Send me the WhatsApp chat on this. So for the learning material or the golden book. Okay. Thank you everyone for making time to join the class. You see, today is a public holiday whereby all of you are supposed to be resting. Some of you even go to the office, but because you don't want to miss the class, you took your time to join. I really appreciate that. When next we are meeting, we are going to be having a brand new topic for those of you that have not started risk and uncertainty with. So thank you once again for joining the class. I will see you next time by the grace of God. And then bear in mind, there is lecture on Saturday and Sunday as normally scheduled. Only tomorrow we don't have class. No class tomorrow. Every other Saturday and Sunday, the lecture continues. All right. So thank you, everyone. Bye-bye.